friends. This is Season 2, Episode 53 of 0 Days to Expiration, and today we're going to talk about... Seems that I had that up. Well, just taking care of some things. There we are. Cool. As I was saying, this is Season 2, Episode 53 of the 0 Days to Expiration. Today we're going to talk about how volatility affects our 0 DTE trade, and both in the short term and also in the long term. Now, short term, it's pretty easy to understand. When I say short term, I'm talking about within the course of a day. What exactly happens to our trade and how does volatility affect it? Of course, if you're trading 0 DTE, then you're in it for the extraordinary premium decay that happens on that 0 DTE event, trading options on the SPX. And that happens 5 days a week. I only need one hand, 5 days. And on that last day, or each day, is another contract that expires. And the reason why we trade on that day is that premium is decaying at its fastest rate in the shortest period of time. Now, during that day, volatility has a lot to do with the reason why we take that trade. Most 0 DTE practitioners are banking on there being what's called a volatility crush event at the beginning part of the session, early in the morning, usually between the open and maybe as much as an hour to hour and a half after the market opens. There's going to be elevated volatility, and then it will dive, what they call volatility crush. And then a little later in the day, usually on that what they call the power hour, it will start rising again. Now, the reason why this is so sought after from a 0 DTE options trader's perspective is that you're probably trading a premium collection strategy like an iron condor or a butterfly. And they're said to be vega negative. In other words, when volatility drops or you have a volatility crush, the value of those butterflies or iron condors increases much faster than normal. Now, that effect is really only good for a certain period of time because we're at that very final day of expiration. Time has a stronger effect on premium decay after let's say around 1 o'clock to 2 o'clock in the afternoon than volatility does. So we're really looking for that sharp move in volatility early on. If volatility stays elevated, then there's little that we can do, right? The premium decay is going to get, how should I say, delayed, at least for a period of time. And you may be stuck in a trade where it's not moving, price isn't moving, volatility isn't moving, nothing's happening, and you have mounting risk sitting in that trade. So that's what you're really looking for. You're looking for that volatility to just sort of fall off of a cliff early in the day, have your position, have it increase the value of your position very quickly, and then get out. Now, that's the way the vast majority of people are playing this trade. Now, one of the reasons why they find it attractive, besides that volatility crush thing, which isn't a regular thing, it happens maybe 70% of the time. Other days, the volatility might rise during the session or stay elevated, and then it's really no good. Or you'll get a minimal effect. It won't be as good. The other problem with that trade is that there's tremendous gamma risk. And what gamma risk means is that's the sensitivity to price, the value of your option trade, your butterfly or your iron condor, sensitivity to price moving back and forth. And really what that is showing is the steep nature of the profit curve if you're getting into one of these at-the-money trades. Now, all of these present big problems for a lot of traders. And they think that they're getting over that by the short period of time that they're staying in the trade and or the high probability nature of the trade. So they'll set up stops, they'll get into the trade early, they'll try to get out as quickly as they can with some minimal amount of profit. And for that high probability strategy, they're putting on a tremendous amount of risk. Now, there are two basic strategies that most people are using. Two strategies that most other people are using, but not what we're doing. And I'll get to that in a second. But I want to first point out the way most people are going after a volatility crush and how they're using their strategies. The two basic strategies are, one, the Jim Olsen butterfly. And that is a trade where you put on a very, very wide butterfly right at the money, right after the market opens. And you're hoping for that volatility crush so that premium will jump and the value of that option will increase by some amount. Now, typically when you put on a 50 wide fly, you're going to have a debit of around $30. And if you figure that out, then that leaves about $2,000 of available premium to collect, because the value of the maximum profit of a butterfly is the spread. So if you're putting on 50 wide minus the debit, and if that's 30 or 3,000, then what's left over is 20 or 2,000. So you put on this fly, volatility crushes, and as soon as it hits about $150, they want out, because they're afraid that if price starts moving left or right, it's going to fall off that gamma curve on either side and then potentially cause a huge loss. The way they stem those losses is that they'll put stops. And usually the stop on the Jim Olsen fly might be maybe stop out at $300, $400, $500, something like that. And you'll get stopped out fairly regularly. But you'll also make money fairly regularly, and there is a positive expectancy if you can manage those stops. There are sometimes the market might just go right through those stops. There's no guarantee that the stop is going to stop you or stop the loss. And so it can be a relatively anxiety-driven trade. Now that's one way to trade that market. The other way is with a very low delta iron condor. And so this provides a slightly less anxious trade, but still very high on the anxiety level. And that's where you put on an iron condor, very, very wide, maybe 5 or 10 delta or 5 to 7 delta wings, creating a 93 to a 95% probability trade. And again, the problem with this trade is that when you put it on, you have very large potential risk and very small potential profit, much less profit than is even available in the Jim Olsen iron fly, but about the same amount of risk. Well, actually, much less risk, because it depends on how wide or how wide you make each of the spreads. But typically, people make them a 10 wide spread. So there's about $1,000 of profit with a 95% win rate potential or probability of profit, with about $100 of potential profit. And they're also hoping for that volatility crush, and they will take the trade off once they've hit 50 cents or $50. So you're putting up $1,000 to make $50 in that trade. And again, it suffers from the same problem that if you go left or right very quickly, then you're quickly going to fall off that gamma curve and then see your profits dwindle away. Of course, they stem these losses by putting stops. Now, these are two option strategies that both require stops, which, from an options trader's point of view, seems antithetical to what options are all about. But they'll put stops in there, and in the case of the iron condor, instead of a 95% probability trade, they're turning it into more like a 70% probability trade with a $300 risk. They usually take about 3 times the available credit as their stop point. So again, both of these strategies are anxiety ridden and really rely on you being an absolute master at putting that stop on and executing that stop. And they're really hoping that you're in that trade for the minimal amount of time, and that is because of that volatility crush. Now, what we do is very different, and we're not really subject to that volatility crush that much, if at all. What we do is a butterfly that's way out of the money, very tiny risk, large potential profit, and we're hoping to stay into the trade for as long as it takes. If price moves very quickly to our strategy, we can make a lot of money very quickly, but we never have enough risk to ever really even worry about it. As a matter of fact, our risk is defined by the strategy itself, and we don't really pay much attention to it. As a matter of fact, I don't manage the risk at all. You make the risk small enough so that you don't have to manage it. So all you're really doing is profit management. There's virtually no anxiety in this trade, and the positive expectancy is much higher than the other two trades, and it's scalable where the other trades are not scalable because of the inordinate amount of margin that you have to put up in order to get much larger wins. With our strategy, you can just increase your risk just a little bit to make the potential win much, much larger. So that's why we trade this. Low anxiety, no drawdown, very little drawdown, positive expectancy in the long run, just overall a much better trade. Now, that's great with all things being equal. But things change over time. And as you know, right now, things are changing. Volatility, although it might be a little bit elevated today, it has generally come way, way down, where most of 2023, volatility was sitting above 20 and in the as high as 24, 25, as high as 27. And then prior to that was even higher, above 30 for some periods of time. But recently, in the latter parts of the 2023 summer, volatility has come down dramatically, way, way down. In fact, it got so low that it was at least 3 years prior to it before we had seen volatility that low. Now, when volatility is in that range, that really low range, it changes the dynamics of all of your trades. First of all, with the Jim Olsen fly and the Iron Condor fly, it puts you in a position where it's much more difficult to get that amount of premium that you're looking for, because this lower volatility, remember I said they are Vega negative. In other words, when volatility is very low, a lot of that premium decay that happens over the course of a week gets accelerated, particularly in the first part of the day, of the trading day. So they're left with much smaller potential profit to go after. And they're hoping even more so for that volatility crush to happen, and it makes it for an even more difficult trade. Now, from our point of view, it doesn't affect us at all. It just changes the dynamics of the trade to some degree and how we would approach that trade. Now, typically when we have higher levels of volatility, that means that we can put on much wider flies and push them further out of the money and take relatively the same amount of risk that we would always take. And that is because of the higher volatility that suppresses premium decay. And so it gives us even more potential profit within our strategies. But our risk that we approach the trade with never changes. It's always super small. But we can actually go after much larger potential trades. When volatility is super low, the premium or the value of those flies that we put on are preloaded with decay, right? So they in the first part of the day they become already bulbous. And I'll do a little. I don't have my iPad with me, so I can't do an iPad show today. We'll do that on Wednesday. We'll follow up on Wednesday with an iPad show. Oh, by the way, if you're watching this and you're getting something out of this content, give this video a thumbs up. And if you're not already a member, this is where you're going to get the straight dope on options trading and trading on the 0 DTE, and you'll get the the most valuable information that that you can find on the internet. All right, so the with volatility super low, our butterflies become advanced in terms of the premium decay. So the first part of the day, they've already decayed almost to their full amount. And that only lasts really for the first half of the day. Like I said, regardless of whether we have low volatility or high volatility, that effective volatility really is only the first part of that day. Once you get to about 1 o'clock or so, 2 o'clock, volatility, no matter whether it's high or low, it ends up being about the same from about 1:30, 2 o'clock on to the end of the day. That part of the day never changes. But you know, we'd like to get into trades and get out very quickly if we can. So what we can do is we find that this advancement of premium decay will affect the narrower width flies even more. So the way we adjust to all of this change in volatility is pretty simple. Where when we have high volatility, we can make much wider flies, push them further out of the money. With low volatility regimes, we use narrower flies and then bring them closer into the money. And so they already have some level of premium decay into it. And so if price moves into it, we have quick profits. Still taking very little risk and then going for that large outsized asymmetric return. All right. So that's, and you know, what I'll do is on Wednesday, I'll chart all this up, and I should have had my iPad here. Darn it. Didn't have my iPad here to show you, you know, a pictorial representation of that, but I will bring that on Wednesday, and I'll show you precisely how we take advantage of volatility, whether it's high or low, and still maintain the same kind of low risk, no exposure to, or very little exposure to gamma, and very low drawdowns and high return expectancy with zero anxiety. If you're interested in this type of trading, go down below, try out go for the trial. It's a 4-week trial. And then if you like what you see, join us for a year, and I'll teach you how to become consistently profitable, independent, and trade at a pro level. These trades that I'm showing people are the same trades that I've been alongside of other floor traders on the exchanges that they traded right on the New York Stock Exchange or the Chicago Mercantile Exchange. This is the trade that they would trade, and I'm here to show you how we do that here with minimal fuss and great long-term expectancy. What's going on over there, puppy? All right. Sorry, got a little interruption. Well, thank you very much, and peace to you all. Hopefully this has been informative. On Wednesday, we'll do a complete pictorial representation of what this actually looks like and how you can put on butterfly trades with little risk and large potential profit and make consistent profits. Thank you very much. Peace to you all. See you next time. Time for the music.